In this module, I like to do is to talk about stocks. Very, very briefly, we'll spend a big chunk, at least a week, on stocks. But in the first class, I just want you to at least guess to think about what a stock is. What are some of the things that can change the value of the stock, and just get the fundamentals of it. Please read some of the supplemental material I've given you. And again, we will, and what is in the textbook, demystifying investments. And again, next week will be a focus on stocks, where we will, look at, calculations of the values and things like that. So, when you probably have gone through the bond stuff by now, hopefully. And again, there we talked about there are two basic ingredients. One is to lend money. Where you get fixed income, which is what the bonds are, or anything where you're lending money, could be a CD. But when you invest it, income is not fixed. You become a part owner of the business. So in some ways, you're taking a risk. But for the risk, there is a reward if the company does well. Okay. So in this module, I'll just talk very, very briefly at a very, high level overview of stocks. So, what is a stock? What makes a stock move? What is a mutual fund? ETF is also like a mutual fund. We'll get through some of this stuff over the next few weeks. So just like in a discussions of the bond, businesses, any business goes through phases. They're starting a business, or running the business, growing the business, and they need cash. Typically, when the business is a startup business, like when Steve Jobs and his partner Paul started the Apple, they got to the point where they needed to grow the business, for which they needed some investment for, doing design, or hiring engineers, or having an office area, or start to manufacturing things. And so basically what you do is you take your business and you find investors. And those investors become part owners, and then, that they become quote unquote shareholders or stockholders. And so a lot of these companies over the time, be Microsoft or Apple or any company, very recently the Facebook, which went public, which means that the owners, sold, big chunk of the ownership to investors who bought shares of Facebook, and they're now owner of Facebook company. So stocks are basically an investment, okay, versus bonds were lending the money to a business. So you own a small, tiny piece of a company, obviously, because you're buying 1 share or 10 shares of a company. You are an owner, but you are a tiny owner because you own very few shares. Okay. Now, what makes a stock go up or down? Again, we'll get more into it in the second week, but in general, the value of the company, if you can kind of visualize it to be like a balloon with certain air, and so it has a value. The balloon has a value of how much air does it have, and you can imagine the amount of air is the value of the company. How much does the balloon grow will depend on how well the company is managed. Basically what that means is, what are the expectations for the future profitability? That means how much will this company be able to generate profits in the future. More profit it can generate, more will the value of this company be, and that means that the value of the company goes up. That means that the shareholder who own itty bitty piece of the company, their value goes up. So what will drive the future profit growth obviously will be things like the products they have. If they have a product that everybody wants to buy, obviously that's going to drive the profitability of the company, and they're going to grow. The industry they are in the sense that, depending on the economic cycle, industry will cycle, and again we'll talk about that. And it is covered in the economic indicator textbooks. As you read it, you're going to learn about business cycles and how the industries move. And depending upon the phase of the economy, some industries will move up, or some will go down. Overall economy, how is it doing? Obviously, if the economy does well, people have money, they're gonna go buy things that the company is selling, and obviously that will make the value of the company go up. Let's say, for example, we take Target or Walmart or TJ Maxx. If the economy is better, people are employed, feeling confident, they will go spend the money at TJ Maxx or at Walmart or at Macy's, and then Macy's will be selling more and they will make more profit. And if they're going to make more profit, the value of Macy's will go up, and hence the profits will go up. And also the other thing is that the proven success, which means they have been able to show that they can do it. So it's not just like a one-time event. So when the companies can show progress for long enough, then eventually they start to see that the values start to go up. Okay, here's an example of Apple. When Apple started in 1985, it was a good company. They had a good computer, Apple. But it took them literally decades before investors felt that this company has a tremendous ability to make profits in the future. It was around when they came out with the iPod, which was something very unique. It was a revolution in some ways for technology. The iPod, and then they also came up with the iTunes. And that's where the stock, investors started to say, this company has got a lot of potential, and that's why the stock started to go up. And then, it like all companies in 2009 when the economy went down and crashed and went up. And today, actually, this chart was done. The date you can see is September 7, 2010. Today, the stock is up at 450. It went as high as 700. And again, we'll have a discussion on Apple in one of our one of the weeks as far as how can you look at a company and see what's going on. But anyways, the notion here is that when companies have to show that they can do well, obviously they have a business model, and then the values start to grow. Okay, so how do companies increase their profit? And what is a profit? The profit is really what you're selling minus what is costing you to make it. That's your profit. So if they can increase sales and reduce cost, that's what increases the profit. So they can have new products like Apple has done with the iPhone and the iPad, and better products people are willing to buy. And if they can make it for lower cost and they can provide better service, then obviously they can make more money. Customers are going to line up to get the products, and obviously that's going to drive the value of the company. Facebook is a good example right now. Facebook is a new company. There are close to 1 billion people on Facebook. But the question is, how will Facebook make profit? And that is still to be decided. They are making profit. There's a new company. But the question is, how much will they be able to do it through this Facebook model? And so time will tell. But if they can, then obviously the profitability will grow, and hence the value of the company will grow. And if the shareholder that owns a tiny piece of that pie, his or her value will grow because their share value will grow. Okay. So there are a lot of things that can happen that can impact the stock price. Interest rates, we'll talk about that, in when we talk about the bonds and stocks. Oil prices, obviously, if the oil prices go up a lot, which means that the companies who need oil, energy, gas for their trucks, heating oil for their factories to run the machines. If the cost of oil goes up, it gets more expensive. So basically, that will affect the profit in the negative way. Any global political tension makes it very difficult. People get nervous. They don't want to travel. They don't want to spend money. That drives the oil prices up sometimes. What are the federal government fiscal policies? What is the unemployment rates? Obviously, if there are more people are unemployed, then they spend less money. Then the companies don't make profit. Overall growth in the economy measured by GDP, what is the inflation rate, what is happening to gas prices, what is happening to the exchange rates, and many, many more. So there are a lot of things to think about, and that's why they are riskier, and that's why there is so much volatility in the stock market, and we're going to talk on some of these issues as we go through this session. Okay. So then why do people invest in stocks? And the reason is because if you want to invest, and if you can only make 1% or less in the bank, and as you're going to go through, when you go through the time value of money, module, you start to realize that, in order for us to save money for the future, we have to at least have our investments grow above the inflation. and inflation is typically 2.5 to 3%. So that's why people would invest in stock market in the long run. They have done better, but there's no guarantee. It is much riskier, more volatile compared to the bonds. But people do take some portion of that money and invest it in the stock market, through individual stocks. That means buying a stock in IBM or GE, or allocating it into a mutual fund, and we'll get into mutual fund quite a bit in a few weeks. So the question does become is to say, okay, if the investment can grow 2 to 3% higher than, say, something that is very, very safe, is it worth it or not? Well, it really depends on the time horizon. So let's say somebody has got $1,000, and the vertical columns are if the growth rate is 4%, 6%, 8%, and 10%. So $1,000 in 5 years at 4% will grow to $12,167. At 6%, it will be $13,382, and at 8% it will be 14. So obviously, it will grow more, and hence there is a risk there. But if somebody puts in a small percent of the portfolio in the stock market, then if the stock market does do what it did over the last many years, then you could have your portfolio, a balanced portfolio, do better than the inflation, and hence your investments are at least growing at a better pace than the inflation, when you need the money, and especially when the time comes to retire. Okay. Now, stock market obviously has got over 14,000 stocks that are traded every day, and in short term they're very volatile. And as you can see, we've gone through it, and we're going to go through some charts especially the next week, as how the stocks have moved in volatility, and what are some of the periods, how long does it take for market to recover, and we'll discuss those things. But in the short run, they are volatile, and it is risky, and that's why you have to be very, very careful. It's what portion of your money you're going to invest in the stock market, and then also within the stock market, where would you invest it, in terms of the risk factor. Now, stock market, typically, if you look at the news, they're going to be, they talk about the major indices. And the 4 major indices are the Dow Jones 30, which includes top 30, the large 30 companies that kind of represents the economy of the United States. They include companies like General Electric, companies like IBM, United Technologies, Cisco, includes insurance companies like Prudential. So they're basically representing all the companies. And it's a composite average, typically you hear about Dow Jones went up or down. That's what it means. The other major index is S&P 500. In here, they got 500 companies, so it is more diversified. And NASDAQ is typically another indicator you're going to hear in the news, and they are mostly technology companies in there, and also some of the companies that are more growth type companies, like drug companies and so on. And Russell 2000 are the index which includes a lot of the smaller companies. In the world of stock market, they will say big cap or large cap. Large cap basically means if the market value of the company is 10 billion, and we'll talk about that, what that means in the next week's class. But the large cap basically means that if the market cap is 10 billion or higher, that's a large cap. If it is somewhere between between 5 and 10, it's called a mid cap, and below 5. Below 1, it is called a small cap. So you've got small cap that is below 1 billion, a smaller company that is just kind of starting out in the last few years. What is the big cap would be big companies that be around for a long time. So typically when they talk about a blue chip company, what they're really talking about the large company, where the market value of the company is over billions of dollars, and they can survive economic ups and downs a little bit better than the small companies would do, but typically those are the indices you will hear in the news, especially the Dow Jones, S&P 500, and the NASDAQ. But sometimes if you look at the newspaper, they'll also talk about Russell 2000. Okay. Now, so because of the volatility, when somebody's investing in a stock, you're really looking at a longer horizon for investing. Typically allow 5+ year off window, and I think some of these years, how many years, why 5, will become more obvious as we go through some of the charts in the next class. And typically for investors, who are beginner investors, don't try to pick a stock. It is, you don't know. It's taking too much risk. It's like saying putting all your eggs in one basket. You want to diversify, and that's what the mutual fund comes in. Mutual funds are really nothing more than a diversified portfolio of different companies in a fund. For stocks, obviously, one can invest, but you need to really understand the company, the industry they are in, what the competitor is doing, what the products are, etc., etc. So there is much risk in there if you start to look at a stock level. Okay. The other thing that obviously, I touched on before is that the stock is more volatile than the bonds. Okay. So here is an example of over the last 5 years. The blue line is a stock fund that represents S&P 500, and the green is a bond fund. So you can see over the ups and downs, the blue line moves a lot more up and down, and which is a stock market fund, S&P 500 fund. Whereas the green line is one of the bond funds, which is mostly tied with the bonds. You can see that it is less volatile. It does go up, but not as ups and down as the stock does. And that's why when people talk about the asset allocation, they want to do is to split their investment between some bonds funds and some stock funds. So this way they don't see all this volatility going up and down and kind of feeling nervous about it. At the same time, if they put everything in the bond fund, then they're taking the risk on the bond side because it may not grow, especially if the interest rate changes. So that's where the asset allocation comes in. But in the purpose of this chart is to show that typically stock funds are going to be more volatile. They're going to go up and down a lot more, which is the blue line, where the bond funds typically are not as volatile in this case, which is the green line. Okay. But if you see over the 5 years, if you put in $1,000 in a bond, that particular bond fund, it would grow by 5%. But if you had to put it in the stock fund, even though it dropped, in over some periods, it has grown much more. Okay. In a shorter period, if you look at less than 1 year horizon, again you will still see the volatility in the stock, whereas the bond is less volatile. And again, if you had, so this you can kind of see the different periods over here. Now, here is the business risk as far as just picking one company. Here's an example of a company called Celsion. They are a drug company. They basically grew. The stock was up at $10. As you can see, but a few months ago, it was in January of this year. And the reason it was up was there was expectation that they were going to come up with a drug that was going to be very successful, and then they were going to be able to make a lot of money. And they failed the drug test, which means that the FDA did not approve the drug, and all of a sudden there is, investors realize that their ability to make profit is very little to none. So the stock price dropped by almost 90%. It went from $8 and right now it is below $1. And it dropped literally, you can see, all within 1 week. And this would be what I would call the example of the business risk, though, unless you really understand the business, understand what is going on. And if you have, if somebody would have put in a lot of money in this business, they would have lost 90% literally in less than a week. Okay. So that's where the asset allocation comes in. Obviously, you want to do is we'll talk about that, in the future classes, where we want to allocate the stocks and bonds. Again, I just want to bring it back to the bond conversation that we had before. Bond, again, is a loan. It could be to the federal government or a municipality. Again, bond holders receive a periodic interest. That's why they call a fixed income. And bond holders can keep the bond until maturity, or they can sell it, if they want, in between. And obviously, the price of the bond will depend on what the interest rates are. And when we go in the week of bonds, we'll get into more detail. Okay. Asset allocation basically means is that the process of placing your assets among different types of assets, which means you don't want to put everything in one basket. Time factor is that you want to also keep in mind that when you need the money, you don't want to put money in the stock market, the money that you would need in a short-term period. Your age, obviously, in the sense that how far you are away from your retirement, so that matters. Okay. The mutual fund again are a diversified portfolio where the investors pool, money is pooled, invested by professional fund managers. You buy a share in the fund, and the funds are diversified into not just one stock but multiple stocks. And the funds will range from conservative to extremely speculative, and we'll talk about all that, and also depending upon your needs. So mutual fund is typically what most people invest in, and we'll go through mutual funds, what they are, and what are the different types when you get in the mutual fund in about, I think 3 weeks or so. So this is a quick overview. I hope it's helpful, and I hope it's going to get you to start thinking about it. So when you start to read the news, when you start to hear the news, at least you will know, at least start to become aware, and maybe start to get into it by researching. So